Okay, we're officially recording. So I am, as an introduction, all of you know me, but I'll just say I'm Donald Butler, CEO of Butler Square Consulting. My experience is way beyond 25 years. I work with large companies, small companies during my tenure as an accountant slash auditor, technically. I audited large companies like Campbell Soup, Armstrong Flooring, federal government, including DoD, SEC, um, Department of Treasury. I mean, you name it. I've been all around the government as well. I've seen the highs and lows from Enron falling back in 2002, 2003, when I got into the industry as a consultant. MCI went down. I even audited AT&T. I don't know if you all know that, but so I did a lot. I've seen a lot. And one thing, me being an auditor, that I realized in business is that I want my clients to understand internal controls as it relates to your business, but also be aware of some of the things that you know you could prevent from happening, like any issues, like saving money with taxes. The misconception is I can save money in my business and not pay a lot of money in taxes. Not true. And it's a gamble. So the gamble is if I want to have a low tax bill, I have to spend money. Your business is not meant to be a savings account for you to save money. I'll repeat that again. Your business is not a savings account. If you have a net profit and let's say your net profit is $20,000, depending on the type of entity that you have, and I'll get into a little bit of details about that really quick, just to educate you. But depending on the type of entity that you have, you could end up paying self-employment tax, which is 15.3% of your net profit. So on top of your income tax bill on the 20,000 that you have left in your business, you can have an additional tax of 15.3% of the 20,000. And so what I tell my clients, which is all of you, you have to spend your money if you don't want to pay money in taxes. Now the balance is, well, Donald, I need to buy a house or I want a line of credit. Well, we have to show that you're profitable in business. So let's just say, for example, if a client just came to me the other day and said, "Hey, I want to get this loan," the lender's like, "Well, we need to see your business tax, and we don't want you to actually show that you lost money in the current year. So we need to see that you actually made more money than you did the previous year." And so I'm talking to the lender. I'm like, "Well, you know that they're going to owe more money in taxes. They know that, but they need to see the income." So then you owe more money in taxes and you're getting approved for this line of credit, balance out that situation. Very challenging. So then I tell my clients, all of you, if you're trying to buy something, we will have to submit it where you owe more money in taxes and then come back and do an amendment later. Now, this can be a somewhat of a complex, somewhat stressful process because when you get that tax bill, it triggers some kind of emotion. And I'm not a therapist, but I got people that do therapy or have a business that provide that service to clients, and you're like going stressed, and you're like, because I got this letter from the IRS, I owe this tax bill because now it includes penalties and interest. Because technically, tax bills are supposed to be paid by April 15th every year. And if it's not paid, your balance calculates based on that due date. If that makes any sense, does anyone have any questions so far as I dive into this? Okay, I'll keep going. So we're going to talk about the purchases, and I want you all to talk to me because I want someone to answer this question. Is it appropriate that you write off anything that you classify as a business expense? Listen, it does like you're not in. in trouble for the wrong answer, but I want to get your thoughts. If you make a purchase for your business, can you just write it off?
I really have no idea.
That's good, Stevie.
I don't
Would it
either. I
be,
thought if it's
yeah.
for my business, then I could write it off. But I'm truly unsure.
Yes, you can.
Okay.
Does it have to be
Okay.
an asset? Because it's considered as an asset only?
It doesn't have to be an asset. Let's say, like, for
Okay.
example, you purchase gas, for your vehicle. That's not an asset, but it's just, an expense.
Understood. Okay.
Yep. So this is what I'm gonna do. There are rules, especially as we're about to cross over in 2026. There are rules for purchases. Hello, everyone. Those of you that just joined, thank you so much. Um, so there are rules with when you purchase something, and this is the reason why accounting is so important. And people think that our job is just simple. We're just sitting there doing nothing, twiddling our thumbs. We're sitting here trying to figure out these expenses and how to categorize it as it pertains to your profit and loss, your balance sheet, which we'll go over. So there's a number of things that we have to consider when we are writing off things as an expense. When you purchase something, we have to ask ourselves, is this supposed to be a depreciated item? Can we take section 179? Have you ever heard of that?
No.
Okay. Section 179, something everyone should know when they start a business and you need to buy certain things for your business. It could be particularly it would be probably an asset. I would say that because it would be something that you actually need to run your business. Let's say, like, for example, real estate investing. You buy a new stove and you're like, I'm just gonna write this off of my taxes. It's not that simple. We have to look at section 179 of the tax code, and that lets you deduct the cost of certain purchases immediately instead of spreading the deduction over many years, which is considered depreciation. So section 179 allows businesses to expense qualifying purchases in the year they are placed in service. And it's interesting, the IRS says qualifying because something has to qualify to be considered a Section 179 deduction, meaning taking the full deduction in the year that you purchase it. Because there are some items that you purchase and would again consider it to be more of an asset. There are certain items that you'll purchase for your business, like a vehicle, that you cannot just take the total expense in the year that you purchased it. And this is the part of accounting that I would say this is not just bookkeeping. This is accounting. And it's important that, and you all hear some of the comments, the responses that you get here. Most people kind of like on the fence. You don't know, you kind of know, you're not sure. Well, this is what I guess, almost, what is it? 8 years of going to school did for me. Getting a master's degree, working as an internal auditor, doing financial statement. I'm like, this is stuff that I had to learn as an auditor. If a client could take an expense as a full deduction in the first year, that they get it, or if they could depreciate it. So my approach to doing taxes, when I'm looking at your books, I'm always looking at it from an auditor standpoint. I'm also a professor for University of Maryland Global Campus. For those of you that may not know that, I've been a professor now for 10 years, so I teach my students this stuff. But as business owners, as entrepreneurs, it's important for you to understand if I'm going to make this purchase before the end of this year, I need to know the rules
Nope, we're playing
concerning
with.
this particular purchase. Thank you all so much for joining. I see some of you just joined, so welcome. So now, with this new administration, they applied what they call the OBBB, there's three Bs, the One Big Beautiful Bill. So under this, the Section 179 is reinforced and preserved as a planning tool for business owners. And it's designed to help business owners invest in the growth of their business while lowering your current year taxes. So now, what's important about the Section 179? Section 179 is we cannot create or increase a business loss. Let me repeat that. So if you make a purchase this year and it triggers you to be in a loss, well, Donald, I spent the money. I should be able to write all this stuff off. Not according to the law. You could say, well, how long has it been like that? Forever. Like as long as we've been alive. But so what does that mean? If you wanted to take, let's say, and let me give you an example of a purchase. You bought a new vehicle. The vehicle costs $25,000. You're like, I paid $25,000 for this vehicle. I don't know. I was told I can write this off. And trust me, I've had this discussion with people and I have to ask questions, and people will argue me down because they're saying, well, somebody told me that I can write this off. I'm like, don't go to TikTok. Don't go to a non-licensed tax person that's telling you something that doesn't follow the law. And what I would do is show you, so I'll take a moment to kind of like share with you the Section 179 and how you can Google it. And this is going to help you all because so much stuff is available online. However, it still takes some level of understanding to interpret what they're saying. So Section 179 of the U.S. Tax Code allows businesses to immediately deduct the full purchase price of a qualifying equipment or software in the year it is placed in service, instead of depreciating the cost over several years. This incentive is designed primarily to help small and medium-sized business improve cash flow by investing in themselves. So the maximum deduction limit is 2.5 million. Now, unless you're making a whole lot of money, you're not able to get to that threshold. And then the phase out is 4 million. Business income limit, the deduction cannot create a net loss for the business. So I show you in writing. It cannot create a net loss for the business. Any questions about that? Because I'm thinking somebody probably have a question. Okay, let me
Could
show you
you,
the
I'm
property.
so, excuse me, Donald, could you
Sure.
explain when it says net loss, meaning,
Okay, so when I say net
exactly,
loss,
what's an exactly? I'm like what the other attendee is asking as well. Yeah,
sure.
an example of a net, that's a great question, yes.
Yep. So I'm going to go to QuickBooks Test Drive online, and I'll show you an example of a net loss. So we'll go to your profit and loss report, which is reported for tax purposes. And many times people are like, Donald, I got a loss in my business. I should be able to take this loss and write everything off. So when we go to reports here, so when you have QuickBooks, I think, your view might be a little different than mine, but as an accountant, I can see the screen a little bit different. So as it pulls up, it's going to come up as a reporting section at some point. While I'm pulling this up, are there any other questions about the purchases? So examples of property while that pulls up: machinery and equipment, computers and off-the-shelf computer software, office furniture and equipment, certain business vehicles with a gross weight rating over 6,000 pounds. This is where a lot of people get like SUVs, pickup trucks for their business. Qualified real property improvements such as fire alarm systems, security systems, HVAC, and roofs for non-residential real property. Even has single purpose agricultural structures and breeding livestock. So that's just part of the qualifying property list. So I'm going to the profit and loss report here. So this is an example company, Craig's Design and Landscaping Services. Can you all see my screen? Just want to make sure.
Yes.
Okay, thank you. So we can see here income that they made money throughout the year. So here is their gross profit, $9,795. Then you have expenses. All your expenses will be listed here. Now they have a net income, meaning a net profit. If this was negative, that means it is a net loss. So when we're saying that you purchase an equipment, let's say office expenses here, it says $18. Maybe perhaps you bought some furniture for your home office, or if you have an actual office in a location, you spent like $3,000. That would take this balance here to a negative, right? Is anybody with me?
Yes.
Yes.
Okay. So it would take it to a negative. And look, people say accounting is math. I mean, but this is simple math. You spend $3,000 is greater than this 1,600, you're going to be in the negative. That's when Section 179 deduction comes into play. Because if you purchase office furniture and equipment, we cannot take Section 179 deduction if it creates a loss. It has to depreciate it over time. Did I lose anyone? Do you all understand?
Mm.
So what does this mean for the accountant? This makes my job even more challenging because a lot of people, a lot of clients take these write-offs to heart and say, I should be able to write off all of my expenses because it is a business expense and I should claim a loss without considering that we have to follow the law concerning this purchase, Section 179 deduction. You all about to get your degree in accounting. Tap your neighbor and say, congratulations, you now join the accounting course 101.
Hey Donald, this is Tracy.
Yeah, Tracy.
So with so I get that. So I think I get it. When you did the $3,000 pay purchase, meaning you can't take that full amount because it would make you take you into a loss position. So you would depreciate it over time versus taking the whole expense. That's what you're saying?
Correct.
So then going into like let's say we want to buy a computer or lease one. Cause with like AT&T Business, you don't necessarily buy it. You just kind of add it to your plan.
Right.
and just pay the wireless fee. So it wouldn't make sense to buy that anyway, right? Or it just depends on your overall picture.
It depends. Everybody's situation could be different.
Uh-huh.
However, to your point, can this purchase be, written off 100% in the year you purchased it, or do we have to depreciate it because of this Section 179 deduction?
And that
So,
would depend on where my income is at that time.
correct. So if
Okay.
it's triggering you to have a loss, if we took 100% of that deduction, then we would have to depreciate it.
Got it. Okay. All right. That makes sense. Thank
Yeah.
you.
But if let's say, to your point about the phone, you're leasing a car. A lease is rent. You're basically renting the car.
All
You
right.
can write off the total payment that you're paying on the lease if it's in the business name.
It is. Okay.
Yeah.
I mean,
Yeah.
I know you're not asking me to confirm it, but yes, I got
No,
it.
no, no, I know you know. I
Yeah.
know. But
But
this is
yeah.
one reason why people contact me about business vehicles and they're saying, can I write this off? And I'm like, it depends. I could say, yeah, it meets the fact that it's over 6,000 pounds to take the Section 179 deduction, meaning you can write it off 100% in the year that you purchase it. But I don't see your books. If I don't see your books, I can't tell you that you can take 100% deduction of the purchase of this vehicle.
Because it could take you into a loss
It
position.
could take you into a loss.
Got it. I understand that. Okay.
Yep. So that's where, again, the non-accountant entrepreneurs get concerned. They're like, but I was told I can write everything off. Uh, that's why the IRS call it qualifying purchases. They're not going to let you get away with it that easy. Um, Now, before I move on, there's more details, but at this point, do you all understand what I'm saying about purchases?
Yeah, and Donna,
Yes.
I just have, I guess, a question. When somebody is starting out, because you can, at that moment, if you're a small business, brand new, you are already in the deficit. You're
You're already in
buying
deficit.
you're renting but when it's time to file, then that's what I want to know. Like when I bought it, I was in a deficit because I'm just starting out. But when it's time to file and I'm giving you this paperwork or I'm showing you this, it's about where I am at that point.
It still applies.
Okay.
You can't take 100% of that expense. You have to depreciate it.
Okay. That's what I wanted to clarify. All right.
Yep. No, that's a good one because a lot of people do start off and they're not thinking, I need an accountant. I need an accountant. I'm like, actually, you need an accountant the minute you start spending for this business
Yeah.
because you're going to purchase things. And if you're purchasing something and you don't know if it's a qualifying property, then you're not going to know to depreciate. Do you understand depreciation?
So, to that point, Donald, are we going to get a list
I can send it,
of
yeah.
qualifying
So
properties
what
and
I'll do, yeah,
mm,
to make sure I educate you all, I try to provide documentation so you can take with you. So yeah, so I will include this, this list of qualifying properties because this is just an example.
and then
So again, it's like before I make that purchase, does this meet Section 179 deduction?
is there a depreciating asset list too?
Yes, which
Okay.
I would definitely share that as well because you have 5 year, 10 year, 27 years, like real estate investment properties. So yeah, I'll share that with you. And this is one of those key things when I do someone taxes. Let me stop sharing for a second. So I appreciate all of you on that refer me to new clients. Like for example, Steve is here. He was referred to me. Kerry was referred to me. Um, but if someone comes to me initially, not even from a referral, but they have gone through someone else that have done their taxes, and I'm looking at their taxes and it has depreciation on there, I'm asking a question. What did they depreciate? And you know the common response I get? I don't know. I'm like, I can't. I don't know what to do because they're not educating you. They're not telling you what qualifies as a depreciated item. They're not giving you a schedule. They're not giving you a list. They're not giving you no details. So you come to me and I look like the bad cop because I'm an auditor. I'm looking at it and I'm like, this doesn't make sense. So I want to I make sure that you're armed with knowledge and get this detail so you can understand. And when you make these purchases, I'm not your CEO. You're the CEO. You have to decide if this purchase is best fit for your business. And then knowing, okay, there's a possibility I cannot write this off 100%. Any questions?
Nope.
All right, cool. So the one big beautiful bill changes things. So I don't care about politics or any of that stuff, but I would say Trump understands taxes to some degree, I guess. He has a team that he works with. So what they decided to do is reinstate 100% bonus depreciation. So let me explain how that works. So Section 179 is often used in conjunction with the bonus depreciation to write off the entire cost of assets in a single year. Section 179 allows you to select which assets to expense immediately up to a certain dollar amount, and it's limited by your business income, which we talked about. The bonus depreciation was reinstated at 100% for qualifying property acquired and placed in service after January 19, 2025, and is taken automatically after the 179 limits are applied and is not subject to a total dollar limit or a business income limit, meaning it can create a net operating loss that can be carried forward. Does that sound like mumbo jumbo? Or y'all understand? So in other words, the rule still applies. You cannot, trigger, well, the purchase cannot trigger you to go into a negative. However, with the bonus depreciation that the Trump administration has rolled back into your taxes, that means that now you can take 100% deduction on that particular purchase if it meets the requirements, meaning qualified property as well as placed in service and acquired and placed in service after January 19th. So if you purchased it before January 19th, don't even ask me. But after that date, yes, we can consider it to be an item that can be written off 100% for this year.
Okay, for 2025. Okay.
Yeah. So the misconception about taxes is that I guess Trump has looked out for only the wealthy, but that's not the case. There are more about this one big beautiful bill that I spoke about last time. That includes on your personal, where you can write off up to $40,000 taxes that you pay, state and local taxes, as well as property tax for your house that you live in. Hold on, let me check what needs to be muted here. All right. So again, on your personal tax, the way this one big beautiful bill works, the taxes that you pay on your residential property, as well as state and local taxes. If you paid more than 10,000, you can write off the full amount up to 40,000. That was capped up until 2025 to 10,000. So it gives you a better chance to position you to pay less money in taxes, possibly getting a bigger refund, um, and also being able to itemize. Are there any questions about that? So the purchase is now. So if you're like, Donald, you're telling me to spend money. So the asset must be purchased and placed in service by December 31st. This is one reason why Grant Cardone, if any of you know about him, you can look him up, research him. But he is a real estate investor, Grant Cardone, and he went to his accountant and said, hey, I need you to do my taxes. His accountant said, oh, you owe all this money. And he said, well, how can I reduce it? He said, there's nothing you could do because not everybody's a tax strategist. I'm a tax strategist. So he went to a tax strategist and said, listen, I got this problem. I owe all this money in taxes. What can I do? It's December. And the tax strategist said, purchase an airplane. So what did Grant Cardone do? He purchased the airplane. He drove that plane, or drove, I mean, Jesus. He flew that plane around the United States delivering products. So Christmas he was working because he placed it in service at the last minute to show it's placed in service. So not only did I purchase it, but I'm using it by December 31st. Okay. So it has to meet that criteria. Any questions?
So you can't buy a new car tomorrow and then have your out of office.
No, you can. So it,
Oh,
it's you're gonna have to show that you actually place it in service for the business and it's used for business 100% by December 31st.
okay. Okay. All right. That makes sense.
So this makes me shift into another topic, which I want to address really quick. So we went over the profit and loss report. This is the report that's filed with your taxes. Now, when you make over a certain amount, like over 250,000, you're considered an S corporation or C corp. We have to report your balance sheet to the IRS as well with this profit and loss report. So I'm going to go over the balance sheet. Before I go over the balance sheet, I'm going to tell y'all something. This is something that screwed me up in accounting when I was started off in college. How many of us come from families that taught accounting? I guess by show of hands. And I lifted my hands and Zoom has identified my hand as lifted, which is crazy. But as you can see AI is really working for us. But how many of you all grew up in a household where your parents taught you accounting? Anybody? Or is that a unified no?
Definite no.
Definite no.
No.
Okay. So that's my story. I didn't grow up in accounting. My mother did not even teach me about finances, period. So when I went to Morgan State, starting off and, when I got to college, that was like foreign language, debits and credits. And where to place the item, like where to place the transaction, that was like something that screwed me up. I failed accounting 3 times, okay? Accounting 101, I failed it 3 times. And Morgan was threatening to put me out of school if I didn't bring my grade point average. So y'all getting a little bit more details about me. And so I had a grade point average of 1.8, I think it was. And I did not feel like that I was a failure. I just felt like I needed to shift gears a bit and figure out a different way to do this. So what did I do? I stopped going to school. My grandmother had a fit. You're not going to go back to school. Da 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 da. So she fussing at me. And I said, Grandma, I know what I'm doing. I went to work for the bank, known as Bank of America. At the bank, I spent like close to 5 years and I learned debits and credits. With that knowledge, I went back to school, and I'll share with you why I'm sharing this period. But I went back to school and I took accounting again and I got a A. And I thought, okay, Lord, should I stick with this? Because this is torture. And and I took my next accounting course and got another A. I said, all right, I'm gonna take this one day at a time or one semester at a time, because I'm not sure. This is, you know, very challenging. And I wasn't sure if I could do this. But one of the biggest pieces of accounting that was confusing was the balance sheet. I think the income and expenses was the most simplistic things to study. But when it came down to the balance sheet, I was like, what the heck is this? And I'm sure you're thinking the same thing. So I'll ask the question, how many of you all understand the balance sheet? If anybody understand it, take yourself off mute and tell me. If you don't, you can say no, I don't know it. Okay, I guess no one knows about the balance sheet. It's okay. Again, welcome to Accounting 101. We're not accredited, but we can act like you get a certificate. The balance sheet is very important. A lot of people think that they can run their entrepreneurship, their business without an accounting system. You need an accounting system. The IRS states it that you need to use a system to be able to create a balance sheet and a profit and loss report. Let me tell you something else about the IRS. They do not give out favors to small business. What they say is applicable to large businesses and small and mid-sized business. It all have to meet the criteria of the law. So just because you got this little Uber, little driving business does not mean that you should not have some sort of balance sheet. And y'all probably be like, really, Donald? And yeah, people don't have it, but they're not, really concerned right now, but it could come up at some later point in time because they know you're not tracking stuff. But a balance sheet is very important. And one thing the One Big Beautiful Bill does is gives you grace. I think somebody's hand is up. Is somebody's hand up? Okay, maybe not. Um, the One Big Beautiful Bill basically tells the IRS, do not audit small businesses. Did y'all hear me?
Yeah, I heard that.
They do. They do.
Yeah,
Yes.
yeah. So the One Big Beautiful Bill, again, basically says, IRS, do not challenge the small businesses over the course of the next 4 years, for example. That doesn't mean that small business should not follow the law, but that just means you have a little bit more time, a little bit more grace to get things together, just in case. Now, somebody told me earlier, they said, Donald, this administration abolished taxes. I think that is not being abolished, but there is less taxes being funded into the federal government for sure. And because they are reducing the tax bills, that means there's less money going into the federal government. The reason why taxes still exist is because you still have federal employees.
Look at that, Charlie.
Hold on, let me mute this. The reason why there's still federal income taxes is because we have to pay workers that work for the federal government. We have to pay their retirement. Without tax money, there would be no retirement for federal government employees. You all understand? So taxes still exist. The burden on the average taxpayer like yourselves has been lifted a bit because you have tariffs. Tariffs, TARIFFS, that means that they're taxing products coming over into the US. I think most of you already know that, but that's helping to relieve you from paying a lot of money in taxes. And I broke this down to an audience, but this is what triggered the shutdown. This is what triggered the shutdown. The reason for the shutdown is because the federal government says, we're not making a lot of money. How are we going to pay SNAP benefits? How are we going to pay health insurance premiums? How? So let me ask the audience here, do you rather pay more taxes to cover health insurance and SNAP benefits? If you do, that's fine. I just want to know, what do you all think? Is that a no?
Say nothing.
You said you won't pay nothing, right? Exactly. Anybody else? Do you want to pay more money in taxes to cover those benefits?
No.
So let me ask you this question, and please speak up. This is not just a donor show, please. What do you think happens when they forgive student loan debt? What do you think happens to the debt?
Taxpayers are covering the outstanding balance.
A
Yeah.
tax write-off for the country.
Tax write-off for the country. That's a good one.
Know how to unmute myself.
Mary, you said you wanted to unmute yourself?
Yes.
Oh,
Did
go
I unmute
ahead.
myself yet?
You
Okay,
here?
so you asking me, do I want to pay more taxes to cover a SNAP benefit? Is that what you
Yes.
said? Yes, I did. Because I'm paying more taxes to cover the big billionaires who are not paying for some of their assets and stuff. They get to write off stuff. I think in terms of, and my neighborhood will be better off if in fact I pay less taxes. No. Well, what if I turn around and have a severe car accident and I can't pay and I lose my job and I can't pay my premiums and I lose my medical? What's going to be there? That's our safety net, y'all. It ain't about us. Trust and believe. If you have enough to start a business, you blessed and highly favored. It's people out there that will never be able to do that. Think about those children who are born with difficulties and stuff. It's just a matter of who getting the bulk of what I'm paying. And the
You're right.
people at the top are not. The two people at the top are benefiting. It's just not. I'm not understanding how they're benefiting more. If a little these right now, people 60 and over are getting $24 a month for food. I spend more of that at Applebee's when I take my children. So you gotta think about that a little bit differently. I just think we need to be more educated before we make that kind of a say no decision. No, no, I don't want to pay no more taxes. Well, if you tell me what you're gonna do with my taxes, and I am all for it. But if you gonna tell me you just gonna give the rich more reason not to pay their taxes, then I'm not gonna be for it. It's so convoluted, you know. So yeah, I want to pay more so people can get their student debt. Yeah, I do.
So Mary raised a
That
good
includes my
point.
own student debt.
Mary raised a good point. Um, so what happens is, because again, I'm an auditor, and you have to look at things from and like, what did the auditors find? When we do our audits, we find that there's fraud, waste, and abuse. When we pay taxes, You don't know where that tax money is going. However, a lot of the tax money is filtered through to nonprofit organizations. So nonprofit organizations are very key to helping the community. Now, my own opinion, from based on what I see, nonprofit organizations are not living up to their nonprofit tax exempt status. There's a lot of fraud. I just saw one of the fraud cases in Atlanta that somebody, a woman, executive or whatever her title is, she was taking money from those benefits to apply them to herself, and she created fake businesses and stuff. And I thought, what? This is what we're talking about. So even though, yeah, if you pay more tax money, a part of it may be funding somebody's benefits. But on the flip side, when you go down into looking at SNAP, there's so much fraud that's been happening that people have abused the system. So who's truly getting the benefit of what's there? So I'm speaking as an auditor. People are not to be trusted. And I've seen this stuff constantly as an auditor. I used to hate it because I'm like, every time I see issues upon issues that people are not doing what they're supposed to do with the money that they have been exposed to. So not everybody's ethical, and it's unfortunate. Accountability, transparency is a requirement. Now, we can't change the tax code. The tax code still allows business owners like yourselves to write off your expenses, to pay less money in taxes. But the reason why we have nonprofit organizations that are tax exempt, they're not paying taxes. The reason why we have that is to compensate for what you're not paying into the government. That's why instead of paying more money in taxes, you could put more money into a nonprofit organization and then dictate where that money should go. So people can truly get the help that they want or that they need. I'm not going to go into it today, but I'll give you an example. So, which I'll share with you specifically about estate planning. This is one reason why it's important for you to understand having a trust and having a holding company to build out your estate plan, and you can set up a private foundation. Because if you're not going to pay money in taxes, you can fund your private foundation and you can say, where do you want that money to go? And if you want to pay for senior citizens to eat or children that are considered homeless or whatever, you can fund those types of things through your private foundation. But that's a more graduated discussion that I will like to get into next year for you all. I think if you all tell me that's what you want to learn, I'll teach it. So let's get back to the balance sheet really quick so I don't hold you too long. So the balance sheet, this tells us what's going on with your business. It shows your bank accounts, checking, savings, uh, accounts receivable. If you're actually submitting invoices and you're waiting to get paid, who may have accounts receivable? That could be somebody that's providing a service. Let's say, like for example, you have a IT company and you're sending your client an invoice, so you're providing some sort of service that like not everybody's sending out invoices to their clients. You might get paid right up front. That's it. But if you have outstanding invoices you're waiting to receive, that's an asset. Okay. You have other assets like inventory. Some of my clients have inventory. There could be undeposited funds, so funds that you haven't deposited into the bank account yet. You could have a vehicle, like we were talking about. You may have purchased this vehicle. It need to be included under your balance sheet if it's owned by the business. If it's under your name is on the title, no, it's not going on the balance sheet. But if your business owns this vehicle, then yes, it will be on the balance sheet because then we have to incorporate the cost of the vehicle and we will also use depreciation. Okay. So going back to the Section 179 deduction, you purchasing assets. Your balance sheet might not be accurate. So then you might have this nice accountant that says, you know, I'm trying to get new business. Let me go after these clients and I know I can clean up their balance sheet and I'll improve everything that their current accountant is not doing right and sell them my services and snatch them up from their current accountant. So then you come to me and say, hey, Don, I'm moving on, peace out. I got this accountant that's looking out for me. They know what I need and they know what I need for my business. I'm good. I'm moving on, blah, blah, blah. I don't know if you can do this. One, I don't run your business. That's why it's important that we understand what's going on in your business. So when you make purchases, I'm not trying to sell you on fixing your balance sheet, but I'm saying I need to know what needs to be included on your balance sheet just in case this little joker or this wild card come over here and say they can sell you something and they give you something better. Okay. I just need to know what you bought this year. So your balance sheet needs to reflect that. What's the one reason why your balance sheet is important? If you wanted to invest, meaning real estate investments, buy property, get a line of credit, they want to see your assets. And if you have assets in your business, I can go to bat with you and get you funding. But if your assets are not up to date and your balance sheet is off, it's hard for me to get you money. So, example, I have a nonprofit. They're not on here because it's too big for them to be on something like this. But they making, or through grant funds, they bring in over, let's say, $2-3 million a year. And I'm looking at their balance sheet. I'm looking at their profit and loss. And so I'm like, look, I can get you funded. So working with me, I've helped them get $500,000 within the last couple of months because they didn't qualify at this time last year. When I tried, I said, I'm going to try, but I'm not sure what I can do. But working with me and got them to a certain point over the summer that I can speak for them and justify the losses that they had over the years, but how their revenue has increased this year with my help, I was able to get them, like I said, $500,000. That's it. So I know my worth, I know my value, and I know what I can do if we have things in order. And I'm telling you like this, Robert Kiyosaki is not a billionaire because he's made the money. He's using bank money. That's how he's wealthy. And a lot of these people that's wealthy, they're not cash millionaires, but they're millionaires or billionaires because of bank funding. That's it. And their assets. So your assets are very important. Liabilities, of course, some people don't like the term liabilities, but if you get a lot of credit for your business, this is something that could be considered very good because it shows the banker, Donald, I want business credit. I want business credit. Well, we need to show what's on your balance sheet because this can prove that you've been paying your bills on your business stuff on time and it's up to date. What would be on your liabilities? If you have a line of credit, you have a car loan, you have a credit card, even payroll. We have payroll taxes. So we have to reflect payroll taxes on here as well because it becomes a payable because your payroll tax is not paid immediately for those of you that are S corps or C corps. Um, they're not taken out immediately, but they're taken out, let's say, on a monthly basis, or they're taken out on a quarterly basis, whenever that frequency is. So we will have a liability account showing that this is payable, and we can track your payables this way. So your balance sheet is very important. Then the last part of this is your equity. So the equity statement is a little bit more complex than what this shows, but many of you will understand what I'm saying when I say owner's draw. Like when you take money from your business, it will show up here. So that's why if I have a client or any of you put it like that, any of you have money that you've taken out of your business, I'm asking you a question. Was this a business expense or did you just move money into your personal account? If you just move money into your personal account, this is where it's going to show up. And we're going to have it as either owner's draw or the shareholder um, disbursement. So it was, or distribution. So it would show up here. Any money that you invest in your business. If you invest money in your business, it's going to show up in the equity section here. So those of you that's starting a business, if you're like, Donald, I started my business, then I would say immediately, let's set up a bank account so you can run all your expenses through your business, but also you would show that I invested in my business. Unless you're going to set up a loan in your business and you're like, I loan my business $1,000, then it will show up here as accounts payable. Okay. So the balance sheet is very important. And, so this is something that, for example, I'm helping clients clean up, but I do charge for this because some of the things that I've seen with some of the books, I didn't cause it. And I'm like, I got to clean up somebody else's work. And that's why I know like somebody can try to sell you on fixing something like this and you don't even know what that really means. But this is what this is one of the things that's important with your business, not only the profit and loss, but also the balance sheet. I don't want to hold you all too much longer. I know it's at the hour, the top of the hour, but if there's any questions, I can definitely address them. I'm going to stop the recording so you all can feel free to engage, but thank you all so much for coming.